Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at safe and green holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, let's unpack this one. When we look at the trading history here, the word volatility really doesn't even begin to cover it.
No, not at all.
We're talking about extremes that are, frankly, a little shocking.
You are not wrong. I mean, over the past 52 weeks alone, the price has swung from a low of what? 1.81?
$1.81.
All the way up to an incredible high of $122.88.
Wow.
That is an almost unbelievable range. And it immediately signals that we're in the land of heavy, speculative, retail-driven trading. This is not a quiet utility stock.
And that massive swing, it also tells a story of pain, right? As of right now, year over year, the stock is down nearly 97.5%.
It's been an overwhelming, just dramatic bear market for this equity.
And yet, despite that really bearish backdrop, this is where it gets interesting. Just recently, after some news, it spiked.
It really did. Following announcements about strategic shifts, some M&A stuff, the stock spiked over 33% in a single day.
That kind of action is just pure catalyst trading.
It is. It shows this intense hunger the market has for any positive news, no matter how small or how far out the execution date might be.
So if we try to filter out the noise of those dramatic single-day spikes, what does the underlying technical structure actually tell us?
The structure is fundamentally challenged. Despite those little rallies, the price just hasn't been able to sustain trading consistently above either the 50-day or the 200-day moving averages.
So the long-term trend is still just pulling it down.
Gravity is still in effect, yes.
Yeah.
However, the short-term picture is it's in delicate balance. Right now, momentum indicators are pretty neutral.
Okay.
The RSI, the Relative Strength Index, is sitting right around 51, and the NCD is trending flat. That suggests we're in a consolidation phase.
So just sort of resting after that last spike.
Exactly. But it is not a confirmation of a new, sustained uptrend. Not yet.
So for a trader who might be thinking about diving into this, what are the concrete lines in the sand? What levels should they be watching?
Okay, so support right now is tenuous. It's hovering just above that psychological $2 mark. That level is critical.
Right.
If the stock breaks below that, it risks entering a new free fall phase.
And on the upside?
On the upside, resistance is incredibly strong between $3.50 and $4. That's where previous rallies have just fizzled out as sellers flood in.
So what's the outlook for the next few months?
Our analysis suggests that if the current merger optimism holds, the stock might trade between, say, $2 and $6 over the next quarter. But you have to understand, this entire range is dictated by speculation.
Not by institutional confidence.
No, there is an absence of large accumulation here. It is all retail movement.
Right. So we've established the technical picture is a battlefield. But, hope isn't a strategy. We have to look past the charts and see what the financial records actually reveal.
And this is where the red flags really start to multiply. Let's start with revenue. They reported trailing 12 months revenue of about $4.98 million.
Which is up slightly, right?
It is, up slightly from the prior year. But when you zoom out, the revenue trajectory is the definition of unstable. They saw a growth of about 25% over 5 years.
Okay.
But revenues actually collapsed by over 50% in the last 3 years alone.
Wow. That kind of swing just suggests deep, recurring operational instability.
And massive restructuring failures, yeah.
And if the revenue is that volatile, I have a feeling the profitability picture isn't much better.
You would be absolutely correct. Profitability is a major material concern here. Margins are deeply negative. We were talking about a gross margin of negative 49%.
Negative 49.
Yes. And net income for the last fiscal year was a loss of nearly $17 million. You can't find evidence in the filings of a clear operational path to profitability right now. It's a high-burn environment.
A high-burn environment needs constant fuel, which means cash. So let's shift to the balance sheet, because this is where the survival question is. How strong is this company financially?
The balance sheet is screaming stress. First, it's highly leveraged. The debt-to-equity ratio is 0.63. But the real danger is in the liquidity metrics, and this is the data point you really need to pay attention to.
Okay.
The current ratio is a dangerously low 0.2.
0.2.
And the quick ratio is effectively 0.
A current ratio of point isn't just low, that's a severe alarm bell. Can you put that in perspective for us?
Sure. It means for every single dollar of short-term debt they owe, so things like accounts payable or payroll, they only have 20 cents of liquid assets available to cover it.
So there's an 80-cent gap.
An 80-cent gap. That is critical. It signals that this company is reliant on short-term debt or asset sales or, most likely, emergency financing just to keep the lights on.
And if cash flows are negative, which they are,
There's no cushion. And this liquidity crisis has forced the auditors to include an ongoing going concern warning in the filings.
okay, that phrase, going concern, that's about the scariest language a company can have in its financials. What does that functionally mean for the listener?
It means the auditors project that based on current financial health, the company will need significant new capital raising
Some more cash.
or deep restructuring actions, probably in 2026, just to continue operating. They are not confirming viability without massive outside intervention.
That paints a powerful picture. So if the fundamentals are this challenged, the excitement must be driven by a narrative of complete reinvention. What is this major pivot they're trying to execute?
They're attempting a massive pivot toward growth through new technology and strategic M&A, and they're specifically targeting the energy sector.
Trying to get away from the old loss-making parts of the business.
Exactly. The shift centers around a few key deals. They've announced merger or acquisition initiatives with companies like Makfu and Olenox. The core idea is to leverage tech, specifically AI-driven well site monitoring.
Okay, so a new high-margin revenue stream, potentially.
That's the hope. But the most compelling and the most risky part of this involves Olenox. They are launching a new drilling campaign that's targeting a major output, 1,000 barrels of oil per day by the end of 2026.
1,000 barrels a day is a specific metric that would absolutely transform the top line. But waiting until the end of 2026 for those results, that's a long-term story,
It is, and that gap between the announcement and the execution is a massive risk.
especially given the financial situation we just discussed. They don't have infinite time.
They don't. And that leads us to the biggest piece of pure speculation fueling all this excitement right now. The Rock Springs Energy Group rumor.
Okay, what's the market chatter there?
The chatter is all focused on the execution of a potential $35 million Rock Springs refinery acquisition. If they manage to close this deal,
It's a whole different ballgame.
it would be a transformative entry into refining and broader oil and gas operations, a huge move up the energy value chain. The whole narrative shifts overnight from struggling company to aggressive M&A growth play,
It gives investors a completely new story to buy into.
a powerful one. But before they can finalize these massive deals, the company has to survive. And survival, in the eyes of Nasdaq, means compliance.
So what are the extreme measures they've already had to take just to maintain their listing?
Survival meant drastic action. We saw them implement a 1-for-64 reverse stock split back in September of 2025.
1 for 64 is huge.
It was not a strategic choice, it was mandatory. They got multiple warnings from the exchange about failing to meet the minimum bid price rule.
And the reverse split was the only way to inflate the share price and avoid being delisted.
Correct. It highlights the urgency. They had to solve that compliance problem to keep trading on Nasdaq. Because if they fail that, their ability to raise capital for all this M&A just vanishes.
Which brings us to the single most critical near-term event that you need to track.
Absolutely. It's the virtual annual meeting scheduled for December 29th, 2025.
And what's riding on that meeting? It can't just be routine board elections.
Oh, it's far from routine. Shareholders have to approve crucial proposals, most significantly, preferred share conversions.
And why are those so important?
These conversions are essential for providing the flexibility to conduct future capital raises. No major investor will touch a company with a messy governance structure, especially one with a going concern warning.
So if these proposals fail...
The entire M&A strategy is threatened because they won't be able to secure the financing.
Okay, so let's put it all together. For anyone tracking this volatility, what are the major dates or events in the next 90 days that could move the needle?
First and foremost, the outcome of that December 29th annual meeting. Approval there is foundational.
Right, for survival and funding.
Second, look for the Q4 and full year 2025 earnings report, probably around January 13th, 2026. Investors will be desperately looking for any sign that the new tech revenues are starting to materialize.
And the third catalyst.
Is simply news flow. This stock is totally reliant on that M&A narrative. Any press release about partnerships, tech deployments, or especially a confirmed closing of that Rock Springs deal could generate the next massive spike.
We've focused a lot on the potential upside, but we have to circle back and reiterate the downside risks.
The two main company-specific risks are critical and, well, potentially existential. Number one is the lack of liquidity,
The cash problem.
the cash problem, the low ratios, the ongoing cash burn. It means capital raising is not a possibility, it's a necessity. Failure to get funding will lead to restructuring, or worse. You cannot ignore that going concern warning.
And the second risk relates directly to their big growth strategy.
That's the execution risk. This company is betting its future on successfully pulling off a highly complex, multi-layered M&A strategy, Olenox, Mokfu, Rock Springs, while also launching a new drilling campaign,
That's a lot of plates to spin at once.
especially given the company's volatile past and prior failed restructurings. Success here is absolutely not guaranteed. They have to execute flawlessly.
So, bringing this all together for you, the listener, what's the clear investment thesis here?
This is definitively not a passive buy and hold long-term investment. It's just not.
So who is it for?
This is best suited for highly risk-tolerant, agile traders who are focused exclusively on short-term, catalyst-driven spikes.
Yeah.
You're trading the narrative of a transformation, not the current value of the business.
An agile trade on a story fueled by hope and speculation.
Exactly. And the key question for anyone watching this stock is whether the potential upside from these M&A deals, if they execute perfectly, which is a huge if, is worth the known material risk from the liquidity concerns and the auditor's explicit going concern warning.
You have to ask yourself, is management truly executing a visionary pivot, or are they just performing CPR on a balance sheet long enough to get the next round of emergency funding?
That is the answer that will determine whether this stock lands at $6 or back at $2.